Hi, Larry Gaines, PowerCycleTrading.com. Well, as a trader, you're always on the hunt or the lookout for a good trade that presents multiple trading edges. So here's one that's looking pretty interesting here. This is FSLR, and it's had a really big, huge sell-off. Okay, so from the high back in January 25th to the low currently in March the 5th, we're starting to see this pattern is starting to set up as a cycle low reversal, and it's also a cycle low reversal off a weekly time frame. So we've got our momentum first off on the daily cycling up, cycle 1 and 2. So this has given us potential direction to the upside, and we're starting to have the 4-hour also correct up and the 1 hour. Now the other thing that looks good here is it's got a volatility squeeze. See those dots here? That represents a coiling pattern, which can be very explosive for a movement either up or down, and we look at the momentum to give us potential direction. So right now it's looking more potentially directed for an upside move, also having a volatility squeeze starting to form also on the daily time frame. So you can see here on the daily time frame it had a volatility squeeze and it triggered to the downside. See the momentum shifting down. So this had a big sell-off. Now the other thing to point out is this is also looking like a weekly retracement reversal off the long-term chart. So let's take a look at that next. So looking at the long-term chart, the weekly, you can see there's a big massive cluster of moving average support here below. So here's the 50 simple moving average, 100 period moving average, 150, 200 period. So really big strong layers of support. So the other interesting thing about this is the potential trade selection that I was looking at is to potentially look to do this as a calendar spread, and I'll show you why. Now one of the first things I always look at is just the trade setup itself based on the chart patterns and momentum. Second thing though, then I look to what kind of option strategy could we use. So if you look here to FSLR, you'll see that the option series, these different series, here's the 26th March for expiration tomorrow, and then you got the April 1 next week, 7 days. And then you look here further back, and here the first thing you can see, this is the implied volatility of this series. So it's showing right here for the 1 April series 53.06% implied volatility. Now if you look further back here, you can see that when I look here at the 30 April, it's got a 50.92 implied volatility, and the 7 May has even less. So what this tells me is that there's potential that the closer in 1 April series is higher implied volatility for the options. Therefore, the price of these closer in dated options are going to be priced higher relative to the implied volatility part of that option price. Now, option pricing is composed of two major components: time value or time decay and implied volatility. So if implied volatility goes up, the price of the option goes down. So the calendar spread might be a good one for this, because if we look here to the April 1 series, and I'm looking at a target of potentially 85 right here to the upside, 84, 85 right in here. This is a kind of resistance area. If you look here at the implied volatility, let me put in on implied volatility. So first off, look down here on this 30 April series, 36 days out. What you would want to do is look to go long this series. So looking at either go long the 84 strike or the 85, kind of targeting this area here. Now, if you look at the implied volatility, you can see that on the 84 strike, the implied volatility is 47.72. If you look up here to the 1 April 84 strike, you can see it's 49.11, and then on the 85, just almost the same, 49.72 on the April 1, and then 48.86. So that's a positive, what we call a positive horizontal skew, and that says relative to this backdated, long dated, this has a higher price, not in absolute terms, but the price is made up of a higher component from that implied volatility. So what you want to do on the calendar, if you find this kind of situation, it makes for a good trade where you buy the long dated. So we could come back here, we buy the 30 April, 36 days out expiration to play this for a longer term trade up. We buy either the 85 or the 84 strike here, and then sell against it the 84, 85 here to make this a calendar, taking advantage of the higher implied volatility on the front end, and also the higher theta, positive theta here versus the theta on the back end. So let me show you that real quick. So the other added benefit here is that if you short series here, the April 1, you're going to collect your theta decay is 13 cents or $13 a day. Your long dated that you'd be long back here is 7 cents. So you've got a positive, what we call a positive theta differential of about that's about $6. Okay, so you got a positive $6 here, and then the horizontal skew. So here's the trade setup and what it would look like. So could look to do a calendar the 85 calendar. Okay, so this would be buying the 30 April series, the 85 call, and then selling the 1 April 85 call. Now that trade, if you were setting this up this afternoon, that would be around $2.40 or $240 per spread. So that's your max risk debit paid. So if you look and break this down, what you're going to be trading or having, you're going to be long this 30 April 85 call going at about $3.30 or 330, and then you sell against it the 1 April 85 call, bringing in $90, and you've got this on for $340. Now, if you go out next Friday on April or Thursday on April the 1st at 85, the income side of this trade will be up over $200. So this is about 80-90% return. But if it doesn't, what you can do, if you think the direction is still going to be up, we can just leave that or let that expire worthless, keep the $90. That will then reduce the long dated 30 April 85 call that you set up originally at $330. That'll reduce that down by 90. So this will be down to about that would be $240. So you reduce this price down by $240. And then what you do is you sell the next series out. So I'd sell the 9 April or something. So it's based on the fact that if you think this has bottomed out, this is a great way to trade an upside move and take advantage of the different advantages that the option Greeks give you. In this one, having positive horizontal implied volatility skew, that's an advantage, and also that positive delta on your theta. So if you'd like to learn more about these types of directional trades and the option strategies used, make sure to check us out at powercycletrading.com. Good luck trading.